Jam. What is going on, everybody? Welcome to another daily digital download for Tuesday, June 16th, 2026. Welcome. Today's an interesting day. Everybody's talking about SpaceX still because this low float, high FDV stonk is mooning right now, mostly because the degens want something degenerate to degen with. Let me just exit this erroneous post. We continue to trudge forward in the bear market of 2026. Times are not bad. Not bad at all. Let's start with something negative, and then I think there's a lot of interesting news today. But as we continue the trend that we've seen throughout all of 2026, tech and finance and crypto entities are laying people off. Unfortunately, that's just what happens during bear markets, and we are in one, folks. Robinhood has cut 10% of its staff, largely because they didn't perform in Q1. They're restructuring to flatten management layers and accelerate product velocity. This is one of the key kind of themes I'm seeing with the AIization of everything going on. Whoa, how did we get rid of that? Basically, like Coinbase announced recently that a lot of the new folks they're going to be hiring are going to be player coaches. Long gone are the days of middle management. If you're a middle manager in any sort of forward-looking company or entity, you're probably going to lose your job because AI can replace a large subset of management skills. When I look around at the job that I do on a day-to-day basis, management is ensuring that others on my team know what I'm working on and what I've achieved. Why do I need to have a middle manager write a bullet point list for me and then share that information with their superior? We just don't need that anymore. It's not a part of the corporate structure and strategy like it was necessary decades ago when middle management was introduced. If you look at the composition of an army, you have like a head general at the top, and then generals below them, and then a series of subsequent groups below, and below. And this is by design so that a person at the top can trickle down information and have the whole army operate based off of how their management system is set up. Well, corporate America is not a military. Corporate world, I guess we should say, because we're not just talking about America. And middle management is no longer necessary. We can actually have team members managing their own teams of AI agents. And while we're not quite there yet, when I was knee deep into building out my agents, the more I tried to integrate them into my day-to-day processes, the more I found I was just fixing bugs every morning, especially when I was trying to have those agents act autonomously. Now I have my agents set up where I trigger their actions and I know exactly what they're going to do. And that makes it possible for me to use AI agents in my day-to-day job. That being said, a large reason that entities and companies are giving in 2026 about laying large swaths of their staff off is improvements that AI is offering. And often you'll see, if you read between the lines, it's these management layers that they're displacing. Look at Jack Dorsey's explanation for why Block laid off 40% of their staff. Look at what Coinbase said a few weeks ago when they, or I guess a month and a half ago at this point, Hope all my Coinbase homies are able to find new work in the time since they've been laid off. But Brian was talking about player coaches and manager-like roles being in the trenches with their team and building alongside managing. And now we're seeing Robinhood say that they're flattening management layers and accelerating product velocity. This to me reads as AI as the reason without stating AI as the reason. So kudos to Robinhoods for not AI washing your layoffs. The CEO, Vlad Tenev of Robinhood, said that the workforce reduction is being executed proactively, with the company noting that it remains in the position of business strength and intends to continue hiring strategically in priority areas. This largely is probably a result of Robinhood missing expectations for first quarter profit as crypto-driven market volatility weighed on trading activity. All exchanges are down since October 10th, 2025, with the exception of the random days when we had peak fear or peak euphoria and there was a lot of trading happening. This could largely point to why Robinhood is restructuring. I don't know. I only wanted to include this in this week's Daily Digital Download because a lot of these Daily Digital Downloads have been highlighting since the start of the year for 6 months now, all of these crypto and tech companies that have been laying people off, largely citing AI as the reason. But I think if we look really close, this little segment says a lot. First quarter, missed expectations for first quarter profit as crypto-driven market volatility weighed on trading activity. Now, I do want to get a little bullish. And if you're not yet, folks, I'm sorry for what I'm about to say. I'm sorry for the words that are about to come out of my mouth, but you need to follow this banker. Jeffrey Kendrick, the global head of digital asset research at Standard Chartered Bank, has come out with yet another banger prediction. I've been a little bit cynical of Standard Chartered's takes this year. They've really been, for the past month, 6 weeks, have really been pushing out commentary about a forthcoming bullish run in the blockchain and crypto space. I was thinking that this is largely because they are building out their suite of tools that integrate blockchain and crypto. And now, Sir Jeff is saying that the price of Uni, the Uniswap token, could rise by 40x from its current price by the end of 2030 as tokenized assets increasingly move into DeFi. The value of tokenized assets active in DeFi is expected to grow 37x between now and the end of 2030, and Uniswap is well positioned to benefit from that growth, so says Jeffrey. He expects that on-chain tokenized assets will grow from $340 billion today to $4 trillion by the end of 2028, with the same share used in DeFi rising from 3.5% to 30% by the end of 2030. I am going to group RWAs and stablecoins into the same category for this argument. It is not just Standard Chartered. It is several banks. It is indeed the U.S. Secretary Treasury stating that by 2030, the RWA and stablecoin markets are going to be vastly larger than they are today. All of these guys have been saying this for at least all year, for at least since the beginning of 2026, probably a little bit longer. And we're in a point in the market right now where it's a bit of disbelief. Where and when are we going to see all this liquidity coming into the blockchain space? When are we going to see all of this TVL increase? Well, I don't know when, and I don't know how, but I do find it, and I can't believe these words are about to leak out of my face. but it is the bankers that we have to look to to understand where we're going. If these guys are super bullish on the future of RWAs, stablecoins, and DeFi, we have to listen to what they're saying. The whole reason why we built these systems is because these guys disproportionately benefited from the previous power structures that were. And now, if they're buying into the rebirth, to the evolution of monetary power structures, why? Why are they doing that? Is it because they're fully allocated? I don't know. But the more you see banks and bankers and the governments espousing these large growths in market caps for asset classes, tokenized asset classes, the more I think we need to pay attention. Jeffrey also compared Uniswap with Coinbase by saying Uniswap is like YouTube and Coinbase is like Netflix. Just as YouTube provides an open platform where users can create content, Uniswap provides infrastructure where anyone can create liquidity pools and trade tokens. Coinbase, by contrast, operates a centralized exchange and manages its own trading infrastructure. An apt analogy, says me. He also noted that recent changes to Uniswap's fee model might make Uniswap a more attractive trading platform. The unification upgrade that happened in December of 2025 activated protocol fees and introduced programmatic uni token burns, with later governance votes expanding fee coverage to more liquidity pools. Since the fee switch was introduced, Uniswap has generated about $21 million in protocol fees and burned another 5 million uni tokens, which equals an annual burn rate of about 1%. I am led to believe that it is this burn rate that also has Kendrick, Jeffrey, a little bit bullish on the uni asset. That being said, I would be remiss if I did not include the fact that even though Jeffrey Kendrick has been espousing supremely bullish crypto takes for the past month and a half, 2 months, he also pointed out several risks. And that includes several smaller DEXs could build better products. Clearer regulation is necessary. And yeah, competition is possible. Regulation is necessary. And those were the two caveats that he included. Let's continue on this trend of the institutions being a little scared. Well, Standard Chartered isn't scared. They're bullish. Their bags are packed. They're ready to go to the moon. That being said, the IMF is terrified of Nigeria's stablecoin adoption. Some might recall when El Salvador made Bitcoin national legal tender, it was the IMF that stepped up and said, no. And I would argue levied a series of threats that were strong enough for the government of El Salvador to remove Bitcoin as legal tender. The IMF says Nigeria's surging stablecoin adoption is testing the limits of existing monetary and regulatory frameworks, as households and small firms are starting to use stablecoins for cross-border payments. This was the whole reason why I got excited about blockchain and crypto in the first place. Anyone with a mobile phone and access to the internet can participate in global markets outside of the previous power structures that existed. And the IMF is shaking in their boots. They're saying the quiet part out loud right here. The IMF and institutions that had power before do not like the democratization of money rails and money networks. And they're saying it right here. Anyone with access to a smartphone and the internet can receive remittances or make cross-border payments in minutes, often at a lower cost than traditional channels. The average cost in sub-Saharan Africa for sending $200 is around 9% of the transaction value, while the global average is 6%. So these are a people, this is a population, this is a group of individuals who are using technology that's available to them because they're economically benefiting from it. And when the IMF can't issue you debt and keep your country in debt for decades, they start to get scared that they're going to lose power and the grip that they have around the world. According to the report that they put out, domestic conditions also accelerated the shift to stablecoins in Nigeria in 23 and 24, including a sharp depreciation of the local currency, the naira, persistent inflation, and limited access to official foreign exchange pushed households and small firms toward dollar-linked assets to hedge currency risk and settle payments with overseas suppliers. Look, this is why I'm a free market maximalist. Give the people access to the technology and they will use it when it benefits them. And I'm sorry if the IMF and other powers that be are not making it possible for the most disenfranchised of our brethren, the folks who live in parts of the world where they've been unable to access bank accounts. There's so much corruption at their telecom level, at their banking level, that there's no trust in government and in larger institutions. Give them access to something that can empower their lives, and that's what blockchain and crypto did. And this is the quiet part out loud. The IMF is saying it right here. I'm about to tell you. The same features that make stablecoins attractive are also what scare the IMF. The widespread use of US dollar-denominated stablecoins can resemble a digital form of dollarization, potentially reducing demand for local currency and weakening the transmission of domestic monetary policy. The IMF puts these countries into debt so that they can never be out of under the thumb of coercion from the IMF. This happens to many, many, many countries around the world. I, for one, am in favor of empowering people from the ground up, empowering a grassroots population to rise up and to use technologies that benefit their lives and themselves so they don't have to listen to the lies of government and quasi-governmental entities. Nigeria accounts for roughly 60% of sub-Saharan Africa's stablecoin inflow since 2019. This is a part of the world that is hungry for stablecoins, that is hungry for access to markets outside of their country, and the IMF is shaking in its boots. I absolutely love to see it. I really do. Let's move on to Bitcoin lending, which I've actually had conversations with family about how they might have to sell their Bitcoin, and they're terrified of going into Bitcoin lending because they need whatever money they put into Bitcoin, they need it for a real world expense, for housing, for food, what have you. And this particular family member has been in the blockchain and crypto space since 2020. And when we start talking about Bitcoin lending and what can go wrong, what are the companies that you think about? I personally think about Celsius, BlockFi, Voyager, Digital, and Genesis. Oh! Those are the firms that went bankrupt because of crypto lending and the degeneracy and contagion that ensued as a result. So, Ledin is a lending platform, and the founder, Mauricio Di Bartolomeo, projected that the Bitcoin-backed lending market could grow to $1 trillion in the next 5 to 10 years, arguing that investment-grade bonds can unlock institutional investment in the sector. Ledin issued Canada's first Bitcoin-backed loan in 2018 and has become one of the sector's largest lenders since. The company now estimates it accounts for roughly 30% of the global market of Bitcoin lending, originating $1.4 billion in loans in 2025. Now, this is a big number. Getting to $1 trillion in the next 10 years is large. How necessarily will Bitcoin lending platforms help get us there? A single balance sheet, according to Di Bartolomeo, cannot provide the liquidity necessary to support a $1 trillion market. Instead, he points to mortgage and auto loans, where roughly 60 to 70% of mortgages and about 25% of auto loans are securitized and sold as bonds. And he wants to use this as a model to follow for Bitcoin. The thesis is if Bitcoin-backed loans can be packaged into similar products that can be securitized and sold as bonds, that could allow lenders to tap into a multi-trillion-dollar asset-backed securities market and attract institutional capital to the sector. In order to get a bond that's meaningful, you need size, you need at least $200 million, and you need a rating, DiBartolomeo said. And he highlighted Ledden's own recently issued bond product that uses Fidelity as a custodian and Jefferies as a book runner. Now, I'm going to read this word for word because it's super important to understand what this means. An investment grade rating is significant because many institutions, including pension funds and endowments, allocate capital specifically to investment grade debt securities, potentially opening a different pool of funding than Bitcoin ETFs or strategy-style preferred stock offerings. Pension funds and endowments buy these bonds in droves. And when we can get them buying Bitcoin-backed bonds, that's when we start expanding our reach of the different type of market participants that are in the Bitcoin space. DiBartolomeo, I am so sorry for bastardizing your name, man. My bad. Said, we were marketing this bond during February, which was during the correction. We're still in a correction. The very interesting thing was during these meetings, a lot of these investors who hadn't bought a Bitcoin instrument before were worried about how the system would work in a downturn. And they were reviewing the deal during a downturn and seeing zero loan defaults in the middle of a Bitcoin drawdown, and that made them feel a lot more comfortable about our processes, end quote. With all this said, the Ledden co-founder said that the bond ultimately ended up 3 times oversubscribed. I am not a bond expert. There's a lot I need to learn about Bitcoin-backed lending markets and securitizing bonds and securitizing these loans. But that being said, this is a way that we integrate and ingrain our beloved digital asset into mainstream finance. Speaking of which, the last 2 pieces of news I want to cover today are good. They're good news. And they both have to do with Hyperliquid. Spot Hype ETFs are nearing $900 million in volume with early demand signaling institutional interest. It's been about a month since the Spot Hype ETFs debuted. Now there are 3, 21 shares, Bitwise, and Grayscale. And the cumulative volume across the 3 has approached $900 million since launch, with net inflows reaching $153 million. Why is Hype so cool? To the crypto native, you might have heard this about several tokens that you've held before, or you've been interested in. But, and especially for anyone who holds a DeFi token, where holding the DeFi token rewards them yield from that platform. I'm thinking specifically of Flocks with the Flamingo Finance DeFi platform. Hype distinguishes itself from other tokens that rely more heavily on speculative demand. 97% of Hyperliquid's trading fees are directed to the Assistance Fund, which creates a direct link between trading volume and token demand through an automatic buyback mechanism. Aha. The investors like this. They like the fact that trading fees are used to buy back the underlying token. All 3 of the Hype ETFs hold Hype directly, the Hype token, and pass staking rewards onto their investors. At current staking levels, those staking rewards are around 2.25% annually, and the rewards are accrued every minute, distributed daily, and automatically compounded. Roughly 45% of the eligible supply in these 3 ETFs is currently staked, representing approximately 434 million Hype tokens. So that's the American institutional side that is liking what Hyperliquid has to offer and its native token. Now, what's going on? Well, Hyperliquid is just experiencing a moment. The price of the Hype token, if it hasn't already, will very shortly hit all-time highs again. And one could argue that's because of a recent stonk launch. The SpaceX IPO fueled $1.4 billion in trading on Hyperliquid as the SPCX perp becomes HIP-3's biggest market. Now, SpaceX debuted last Friday. It was one of the most highest valued IPOs in history. Everybody was excited about it. It continues to go up into the right in price right now. And Hyperliquid's HIP-3 perp for SPCX has recorded $1.4 billion in volume on the day as the pair accounted for 30% of all HIP-3 trading that session. What's going on with Hyperliquid? It's showing itself to be resilient because it can capture what the market wants at the moment, largely because it's tokenizing assets outside of the blockchain and crypto space. Of the top 20 markets, I believe 17 of the top 20, this stat is about a month old, so it might be a little bit less or a little bit more. Of Hyperliquid's top 20 markets, I believe it was 17 were non-crypto pairs and markets. They were commodities, oil, gold, precious metals. And that was the first quarter of 2026. You were just seeing oil and gold and precious metals just ripping on Hyperliquid. And this is why this platform is successful for this next part that I'm about to highlight. That was Q1 of 2026, the commodities markets. Equities perps are starting to blow up in Q2 of 2026, SpaceX being a perfect example. And Hyperliquid is positioned to capitalize on that as well. If you can tokenize, if you have 250 million hype, I think it's 250 million, maybe it's 25 million. Or maybe it was 250,000. 25 something. If you have enough hype tokens, you can create your own market. And so that's what's being done with equities and commodities. And so as the broader US stock market picked up, so too did the trading activity on Hyperliquid. HIP-3 markets serve as a 24/7 venue for hedging and speculating on US equities outside of trading hours, which are 9 a.m. to 4:30 p.m. Eastern Time, Monday through Friday. And now, Hyperliquid is pulling open interest and fee revenue away from centralized markets and equity CFD venues, which previously dominated offshore retail equity speculation. So, Hyperliquid continues to be a crusher of a blockchain product that was released. It continues to be being used outside of traditional crypto use cases. And I would argue it continues to bring in non-crypto natives onto the blockchain technology platforms. So, folks, with all that said, thank you so much for tuning in to today's Daily Digital Download. We have a healthy amount of live viewers. I look forward to seeing more views from you in the future. If you haven't yet, please subscribe to the weekly newsletter of thesmarteconomist.beehive.com, where we cover news stories like today and others in a fact-based, non-sensational, objective manner that you can use to help get your finger on the pulse for what's going on in the blockchain and crypto space without having to worry about being sold a token or having someone pump their bags at you. All right, folks. With all that said, thank you so much for tuning into today's Daily Digital Download. I'm about to have a meeting with a dear friend of mine about potentially expanding these daily live streams to a co-hosted platform, a co-hosted manner. We will see. Anyways, with all that said, thank you so much for tuning in today. Have a safe, fun, and happy rest of the day. I hope your World Cup team is bringing you nothing but joy. And if your World Cup team is not bringing you joy, well, hey, you can always pick another one. All right, guys.